Hello and welcome back to Investing 101. This is the 8th in a series of financial classes. So be sure to check out the playlist to find the classes that preceded this if you haven't seen those yet, and to watch for the upcoming classes that follow this video. Today we're going to be talking about stock options. And first we've got a pop quiz for you. If the market averages 12%, why are we advised to only withdraw 5% at retirement? You might have, we've talked about that a couple of times, including the last time when we showed off the spreadsheet. So give that a moment to think about. The answer is an average doesn't mean you get it every year. You're going to have years with 16%, years with 5%, years with negative numbers. Like if you look at the Great Depression, that was about 7 years of substantial loss in market value. If I recall, it was about 30%, which was, we came somewhere close to that with the Great Recession not too long ago. Well, if that happens at the beginning of your retirement and you're withdrawing, say, 12%, because that's what you're expecting to gain on average, then okay, so let's take your 100% of your portfolio and cut it down by 30% because of some huge depression. And then every year you're taking out 12% of what's left. That over the course of 7 years will leave you with very, very little left, actually. So that when the market recovers, you don't have much principal left to grow back and recover with. But if it falls 70% and for 7 years you only pull out 5%, there's quite a bit left. It's a much better situation when the market recovers. You have quite a bit of your principal and you can actually recover with it. So it's a mitigation of the risk of a market downturn while you're withdrawing money. Now, if you are retired and it's a good year and it grew 16% or something and you want to pull out more than 5%, that might be okay. Just know that growing more than you pull it out puts you in a stronger position in the future if the market were to downturn. But if you've got plenty of money in your retirement, then pulling out more than 5% is probably fine. That's something that you might want to talk to your financial professional about. Next question, how do you assess your own personal rate of return? Are you getting 12%? Are you getting 16%? Are you getting 5%? Who knows? The answer to that, there's a few ways to find that out. A spreadsheet will show you an annualized return rate per month, which if you took the average of that gives you an idea. It's probably not the best way to find out. Honestly, I don't know how reliable that number is. But if you were to track it, your income or your returns, your investments in something like Quicken, or some other financial software, it does offer a way to tell you what your return rate is, both like recently. It'll give, in fact, Quicken will give you the same kind of thing that Fidelity does for a mutual fund when you're researching it. It'll tell you what your 1, 3, and 5 year return rates are, which is great. You can also just go to your brokerage, like Fidelity, for example. If you go to Portfolio Analysis, it will tell you what your personal rate of return is, which over time can help you to calibrate the spreadsheet, for example, when you're deciding what you should say that your personal rate of return is. And it might be 12%, it might be more, it might be less, both because of market upswings and downturns, and also because, again, as we talked about in strategy a couple sessions ago, your time period in life and your appetite for risk can lead you to make different decisions around what kind of investments to make, and so you might outperform or underperform the market in general, and either ones of those can be a good choice for you. So with the quiz out of the way, let's talk about options. Now, options are a high risk investment that you can get into, and it's actually rather complex. There's lots of different kinds of options. We're only going to be talking about a few of them today. Anything else wouldn't belong in an Investing 101 class. This is enough to get you to understand the lingo and some of the basic concepts and the simpler kinds of options, and honestly the more common ones probably. So just at the surface, there are call options, which is the option to buy 100 shares at a strike price. So if you were to buy 100 shares of Microsoft and they're trading at $275 right now, that's what you would pay. But if you have a call option, that guarantees you the right to buy exactly 100 shares per option contract of that particular stock at that particular price within any time within a particular time frame. And so there's an expiration date on these call options. So if Microsoft were trading at $295, maybe you have a call option for $250. So it's basically a $35 discount on Microsoft stock. So that contract, that call option would be valuable. Puts is an option to sell 100 shares of a particular stock at a strike price, which is the selling price. Options can be used to add leverage to your position. Without an option, if Microsoft moves up or down 10%, a stock that you're holding would appreciate or depreciate 10% in value. But an option may move a much greater percentage proportionally. It might move up 10 times as much. So if Microsoft stock went up 10%, the option for Microsoft might go up 100%, double in value. It would be incredible. Or 1,000% even. It just depends. We'll talk about that. So with a smaller investment, you can see enormous returns. But it cuts both ways. If Microsoft were to go down 10%, you could go down 100% or 1,000%. So that's why options are very risky. And we talked about before on it, we showed a chart about how you pay for returns with risk. And at the time I said, but this is volatility risk primarily. You don't need to get into the risk of, I could lose everything. With options, those rules don't apply so well. You can lose everything with options, depending on what you get into. So it really is a high risk kind of thing. And in fact, your brokerage might not let you get into most of the options until you've demonstrated quite a bit of knowledge and expertise and a cool head, and maybe even taken some mandatory classes and signed some extra contracts, because it's such a high risk thing. Options can be used to make money, such as in the case of the leverage that I talked about, but it can also act as insurance to reduce risk, which might sound counterproductive or counterintuitive, because I just said that options are very, very risky. So how could you use them to reduce risk? Well, here's an example. Suppose you own 100 shares of Microsoft stock, and you know that the financial disclosure that comes out every quarter is about to come out, and you're worried that Microsoft is going to have bad news. But you hope that it's good news. You own the stock after all. And so you don't want to sell your stock. It might go up and you get a big growth return. But you also don't want to lose a lot. So what you can do is buy a put option for 100 shares of Microsoft stock at some strike price that's not too far below the trading price is right now. So if it's trading at 285 and you'd be really nervous if it went below 270, then you could buy a put option and with a strike price of 270 and an expiration date that extends beyond the market the disclosure. That way, if Microsoft were to fall below 270, you won't lose any more money once it goes below 270, because you have a contract guaranteeing you the right to sell at 270. Now, if the press release comes out and it's good news, or it's not that bad and the price never dips to 270, well, you've lost the money you spent on the put. So you can think of it like an insurance premium. What you pay on the premium is it's sunk cost. But in the event of a disaster, it kept you safe. And so that's actually how put options can be used as insurance. And in some other, much more unusual portfolios, even a call option could potentially protect you. So let's look a little bit more about call options. Again, a call option is the option to buy a particular stock at a particular strike price within a certain time period. As a buyer of a call option, your risk is capped at the cost of the contract you purchased. So if you put in $500 into call options, you can't lose more than you put in. Now you might think, well, of course, how could you possibly lose more than you put in? There's a way. These are options, they're high risk. But as buying of a call option, you can't lose more than you put in. If you were to write the call option, as in you were selling it to someone else, because you were, when you buy a call option, somebody else wrote the call option, the contract. They're the ones who are promising to sell you the stock at a particular price. If you are that person that actually writes the option, because you can create and sell these options, your risk is unbounded, technically. You could lose an untold sum of money. When you sold it, you would be paid for the sale of that contract. But if the price of the stock were to exceed the strike price, you start to lose money. And if the price were to, let's say in that example, you wrote a call option yourself. You wrote it, not buying it, but you wrote it for Microsoft at $270 strike price. And Microsoft went up 10x. So now it's selling for $3,000 instead of $275 or $280 or whatever it is. Now you have to provide 100 shares of Microsoft stock for only $270, even though the going price is $3,000 per share. So you would have lost $27,000. And in selling that call contract, maybe you only made a few hundred. So, and again, there's no cap technically to what the price of a particular stock could go to. That's why it's an unbounded risk. You'd ultimately have to provide those shares. Now, again, as a buyer, and most people probably buy stocks, buy options rather. You don't have to worry as much about unbounded risk as a purchaser of an option, because as the name implies, it's just an option. If you bought an option, you don't have to do anything with it. And therefore, the most you could lose is what you put into it. Now, there's a term with all options called in the money. And that is what the option allows you to do. It doesn't force you to, but what it allows you to do. If that is a profitable thing, then the option is called in the money. And for a call option, that's when the stock price exceeds the strike price. So if I have a call option to buy Microsoft at $270 and the stock price is $280, then that means the call option is giving me a $10 discount per share. That would be in the money because that contract is actually worth something. It's giving me a discount. But if the Microsoft stock price is $260, then the call option has no intrinsic value. It's not in the money, because why would I want to exercise an option to buy a stock at $270 when I can buy it at $260 from the open market? So in the money is a good thing if you're holding an option. Put options. Again, an option to sell at a strike price, whereas a call is the option to buy. As a buyer of a put option, the loss risk is capped to the cost of the contract purchased, as I said before. It's just an option. But if you wrote the option, if you are offering the contract to someone else, then your loss is larger. But it's not unbounded this time. It's capped at the strike price times the quantity, which is per contract, it's always 100 shares. So if you promise to buy Microsoft stock at $270 per share for 100 shares, then that means when someone exercises that option, you will have to pay out 100 times 270, so that's $2,700. $27,000 you have to pay to buy those shares. Now, that contract will only be exercised if the price of Microsoft shares is below that at that point. When the contract is in the money, somebody will exercise it in order to sell you shares at higher than market value. So what will that have cost you? What will you have lost? Not $27,000. If Microsoft only fell 10% or $10 below the strike price, then you lost 10 times 100, so you lost $1,000. If Microsoft fell to zero because it went out of business, then you would lose the maximum possible, which is $27,000, which is because that's 100 times the strike price. So in the money for a put means that the strike price exceeds the stock price. You don't, this is another unintuitive thing, perhaps. When a put gives you the option to sell 100 shares, you don't actually need to own the 100 shares to own a put contract. You can buy a put contract or a call contract, and you never have to buy or sell the shares. Because these options have intrinsic value. They offer a discount or an above market opportunity to sell. Anybody would want that because there's inherent value to that contract. So if you have a put option that's in the money and you don't have 100 shares to sell, or you don't want to sell them, maybe you have them but you don't want to sell them because you don't want the capital gain tax event, for example, then you can sell the put contract and make every bit as much money, in fact more typically, than if you just exercise the contract yourself. Which gets to the point that most options contracts don't get exercised. They're bought and they're sold again on the open market. Now when I say the loss risk to the writer, that is not to be confused with someone who just sells an option that they purchased. If you buy a put and then you sell it, your obligation is, you don't have any obligation. It's the person who wrote the option to begin with who has to honor that contract. If you sell it having bought it, you're under no obligation, so you don't need to worry about that. So here's what buying and selling options looks like. So this screenshot comes from Fidelity, and here I've entered in Microsoft, and I can see, so I'm seeing the option chains that are related to Microsoft stock specifically. And the current stock price as of when I took this screenshot, which was a Monday, which will come in useful later. So Microsoft is trading at $284. Now, there's these groups of rows. You see this group here, and then you see another group down here. This first group expires in 4 days. Options contracts always expire on a Friday, but not the same Friday. These options all end, they terminate, they expire on the upcoming Friday in 4 days. This next group expires a week later. And you can go on and on scrolling down, and actually you can get options that last for months, several months, potentially. Which gets us to the other part of the value of an option. I talked about the discount value, the in-the-money value. I'll call that the intrinsic value of an option. Like, what is its value immediately, right now? If I were to exercise it, what is its value? And if it's in the money, that value is a positive number. If it's not in the money, it's zero. It's its intrinsic value. But there's another aspect to the price that goes into an option, and that is the time value. What time it has left before it expires, because even if it's not in the money now, it might be before it expires. And if it's in the money now, it might be even more in the money as time goes on. So however much time is left is part of the value of the overall option and goes into the price. So let's take a look at what that looks like. Remember that Microsoft is trading right now at $284 as of the time of this screenshot, of course. So $284, so around here, this is the strike price. I could buy an option, a call option. So there's calls on the left and puts on the right. I could buy a call option for $282.50, and the price of that would be $6.10. If you look at, if you do the math, 284, 282.50, this contract would give me a $1.50 discount right now on Microsoft stock. So that's the intrinsic value. Of this $6.10, $1.50 is intrinsic value. So why is it selling for $6.10 if it's only worth $1.50? Because it has 4 days left. And there's a chance that Microsoft stock will go up in value, say $300. And if it's $300, the person who wrote this contract is on the hook to still sell them to you at the $282.50 strike price. So this discount that's only $1.50 right now could go up arbitrarily high. More likely something sane and reasonable like 300 or something. And then you're going to make $16 per share on that. Now, I need to point out that this price is per share. And as I said, every contract is always 100 shares. So while this says $6.10, the price you would pay if you purchased this option would be $610, which is 100 times this number. Okay. Also, this is just the last trade. And remember, we talked about spreads in a previous class, which is the difference in price between the highest bidder and the lowest asking price. Now with stocks that are trading a lot, that spread is usually pretty small. It's never zero, because that would mean that there's a trade happening right then, and they take care of that. It's always non-zero, but if you look at these spreads here, you can see this particular option, someone's willing to pay $11 for it. Someone else is willing to sell for $11.50. So that's the gap that explains why there's not a trade going on right now. And some of these gaps are larger than others, obviously, but the point is there is a gap, and so when you buy one, you'd be paying not the last price, you'd be paying the $9.60. And if you turned around and sold it immediately, you'd be selling it for $9.10. So you'd be taking a loss. And not just 50 cents. You'd be taking a loss of $50 because, again, you multiply everything by 100 here. So that's a little bit about that side. Puts, on the other hand, there's going to be, okay, so you want to sell Microsoft stock at $272. That's, anybody would be willing to let you sell, like, you can sell me Microsoft stock for $272 because I'll turn around and sell it for $284 immediately, right? So the value of a put, the intrinsic value, is in the is in the higher strike price, whereas the intrinsic value for a call is in the lower strike price, which is why the lower the strike price, the higher the price of the option, of the call option. Over here on the put side, the lower the strike price, the lower the price of the option. So lower, 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 higher. Make sense? So here, why is this not zero then? Like, I would be happy to let you sell me something for less than the market value, right? Because again, there's still time value. This option is not in the money. So all there is time value here. And as you go up, once you cross the 284 barrier, now it's in the money. Because if I have that contract, I can force you to buy 100 shares of Microsoft for $290, even though the market's only paying $284 for it. So that's more expensive. Basically, if you bought this option now, you'd be front loading, that you'd be paying for that discount up front. It's like buying a coupon. If it's if something says it's 10% off for a bag of chips and you want that coupon, think of it as you have to buy the coupon, and the price of the coupon is at least the value that you'd save by getting 10% off. So if the bag of chips was $10, an expensive bag of chips, but the coupon would cost $1. But then you could pass that coupon to somebody else, and if the bag of chips went to $20, well, it's still a 10% off coupon. So now that instead of paying $1 or you bought it for $1, but now it'll take $2 off the bag of chips. Okay. Now I talked about leverage, so let's show you what that looks like. If I had $600 to spend to invest, I might buy 2 shares of Microsoft stock. That's all I could afford, right? Because it's almost $300 per share anyway. So I buy 2 shares of Microsoft stock. Now let's say it goes up from $284 to $300 in the next 4 days. That would be a pretty healthy jump, by the way. But that would get me $16 profit per share. So I'd make $32 for my trouble. Remember that, 32. That's not much compared to what we could do. Let's crank up leverage to its maximum value. Let's say, well, something close to same. We'll say 285, because that's really close to the price. the ticker price here. So if I spent that $600 on options, in fact, let's just spend $465 of it. So $465 is what I would have to pay for this option. And that would be the option to buy 100 shares of Microsoft stock. Now that won't do me any good. I don't have enough money to buy 100 shares of Microsoft stock, but that's okay because most people who buy options aren't going to exercise them, and you're not going to either. Instead, you spend $465 of your $600 on this call option. When Microsoft goes up in 4 days to $300, that's the same event that happened when you only bought 2 shares. But here we bought the option. Now, because you have the option to buy Microsoft at $285 for 100 shares, that's a $15 discount from the 300 that it went up to. $15 discount for 100 shares. So what's 15 times 100? 1,500. Your call option is now worth $1,500, and you only paid $465 for it. So you've tripled your money in 4 days. That's a 300% return on your investment in 4 days. That's an incredible return on your investment. Same rough, you even spent a little bit less than you would have spent on 2 shares of Microsoft and only made $35, which is like a tenth. You made a 10% return on your investment versus 300%. So you see the leverage principle here. But remember how I said it cuts both ways. If Microsoft went down $15 instead of going up $15, if you held 2 shares of Microsoft stock, you would lose $30. Not a big deal. But if Microsoft went down below the call price of what you purchased, so if it was $285, again, right, that's the one you bought, and then it went down to $270, this call option is not in the money. No, you would not want to buy, no one would want to buy 100 shares of Microsoft for $15 more than market value. So your $465 investment is completely lost. So you could have made $30 or lost $30 with shares, and you could make $1,500 or lose $500 with a call option, with the leverage that basically at the ticker price would be. In that scenario that I just totally made up. It'll vary, of course, but the point is small amounts of money can make enormous returns or losses with options when you crank up the leverage. And basically with a call option, the higher the strike price is relative to the ticker price, the bigger the leverage is. Now, if you picked a strike price of $10, just to take an extreme low example, so still, Microsoft is trading at $284. You buy the right to buy Microsoft shares, 100 of them, for $10 each. That's a $274 discount. That's going to be an expensive call option. That's going to cost you $274 times 100, so $27,000 to buy that call option. But there's hardly any leverage there, and therefore less gain and less loss risk. Because unless Microsoft falls from $284 to less than $10, so that call contract will always be in the money. So it's a very safe option. It gives you a little bit more leverage, because basically if Microsoft grew 10%, then you'll get like a 12% return instead of a 10% return. It'll be a little bit more, because basically the strike price takes away from the overall price and basically makes all the proportions look larger. When you cut down or cut up in the price, it's based on a smaller base. Whatever is left, whatever the discount value is, it's the percent, the dollars up or down is a percent of that discount instead of the overall price. So what's nice about this is sort of like with stocks and mutual funds, you can decide what amount of risk you're willing to tolerate. When you're buying options, you can totally set your own risk. It's a dial. You can go almost all the way down to just ordinary stock leverage and risk, or you can crank it way, 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 way up and get 10x or 100x leverage, which if you're really confident or you like to gamble, then you can do that. Now, there's combinations that you can do, and there are options, I guess, that have them built in. There's straddles, strangles, spreads. There's these different kinds of options where you'd get a call if you thought the price was going to go up, and you'd get a put if you thought the price was going to go down. And if you thought that it was going to move either way, you could get both. Because remember, if you guessed right on the call, you were going to make $1,500, and if you guessed wrong, you were going to lose $500. So if you bought both, and you bought a call and a put, and you made $1,500 on one and lost $500 on the other, you still made $1,000, and it didn't matter which way it went. You just made $1,000. That's great, but it had to move. See, it had to put one of them in the money. So that would be gambling on a spread, that it's going to go one way or the other. Like, you don't have to guess which way, but it has to move significantly for you to make money. Then there's the opposite. If you don't think the stock will move, then you can kind of reverse the direction and basically bet in the market that it won't move. And if it doesn't move, you'll make money. And if it does move, you'll lose money. So pretty much options are really powerful in that virtually anything you can predict accurately, you can make money by doing so. And again, of course, you can lose money. So that's kind of fun. Now, one other technique that's worth talking about is if you are the one writing the option, and remember, the risks are really high when you're writing the option. So let's say you write an option to sell a call. Now, there's a couple ways you can do that. If I write a call option for Microsoft at $285, that could be a covered or an uncovered call, which means if it's a covered call, that means I have 100 shares of Microsoft stock right now, and I'm willing to put them on the line. So that if someone says, all right, you said I could buy it for $285, they're now trading at $300, here's the $285 that you promised, give me the 100 shares. I already have them. So the brokerage can just take them from me to fulfill my contract with that other user. And the brokerage doesn't have to worry about my ability to buy, because if Microsoft had gone up to $1,000 per share, well, now I have to come up with $100,000 to buy in order to give them to you for less. The brokerage doesn't know that I have that, and they can't take it from me either. So a covered call, brokerages feel very good about, because they'll just lock your shares so you can't sell them while the contract is open, so that they know they can fulfill the contract on your behalf when the time comes. But then there's uncovered calls, which is I'm going to promise to sell you Microsoft's shares at a particular price, but I don't even own those shares. So that's an uncovered call. And that means if the contract becomes in the money for the buyer, that means I'm going to have to basically, it's in the money to the amount that I'm going to have to now pay the difference in the price times $100. So if the stock goes up to $300, I'm going to have to pay the difference, $1,600 or whatever, to make that good. I don't ever have to actually buy 100 shares in order to sell them back to somebody else, because again, options are rarely exercised. They just hold value. They represent the ability, the option to do it. So here's what I can do. As the author of the call option of $285 strike price, and I don't think the price is even going to exceed that, so I think I'm just going to make money by selling an option that's never going to be exercised. But the stock price goes up. It goes up to $287. I'm like, uh-oh, I already owe $200 to this person. Then it goes to $288. Like, okay, now I owe $300 to this person. I'd really like to cut my losses because there's still a lot of time value on that option, and I could end up owing thousands of dollars to this person. So what I can do is buy an equivalent option to close my position. So in a portfolio, it's like in your stock brokerage account, you'll see you're holding Microsoft or Fidelity, whatever companies or mutual funds that you own. If you sold an option, if you wrote an option, that is, that's also an open position. And if it ever goes in the money, that's a negative value to your portfolio. And as that negative value gets bigger and bigger, I can go sort of buy it back. I'm not buying my particular one back. They're all regulated. They're all exactly the same. You just have to buy an equivalent one to the one you wrote and sold to someone else. And if you buy to close, then basically that closes out your position and it's gone. Your obligation is now fulfilled and you've capped it yourself. It's an unbounded risk if you leave it open, but if you can go buy to close, basically you said, okay, I owed $300. I didn't want to owe thousands, so I bought a call option at the higher price. I sold at a low price, and I bought at a higher price, which isn't great, but at least the option is closed now, and I don't have to lose any more money. Now, the possibility exists too. As the seller of an option, remember, that option can be exercised at any time until it expires. So if you wrote an option, you might be, during the course of it, before it expires, Microsoft stock price can go up and down and up and down. And you might say, well, it's going up right now, but maybe the stock price will go back down and I won't lose as much money. That's true. But if while it's high, the holder of that contract decides to actually exercise it and make the money off of it, then you're on the hook to pay whatever that price is at that time. You no longer have the choice of when to buy or sell. It's because it's up to the buyer. Except, again, you could just close the position by buying one just like it and saying, hey, collapse these two. I sold one, I bought one, I want out of this deal. And people will do that a lot. Again, most options aren't exercised. In fact, if you hold an option, a call option, that's in the money and it's about to expire, it's a Friday afternoon, the stock market's about to close and it's about to expire, but it's in the money. Now, let's say you're at the beach and it expires. Like, you'd lose all that money that it was worth. No, you wouldn't. Because your brokerage, at least Fidelity, I assume every brokerage would do this. It'd be insane not to. They will get you the value for the contract. Now, that doesn't mean you'll exercise it because maybe you don't have enough money in your portfolio to buy 100 shares of discounted Microsoft stock. But your brokerage will handle all the details. Whatever its intrinsic value is at time of expiration, you'll get deposited into your brokerage account, basically as cash. Basically what they did is they went and made somebody who wrote the option pay the difference for the value of it. So that's nice. So again, options can be sold, exercised, or expire. And they certainly can't expire. They tend to expire when they're not in the money. Otherwise, they get redeemed or exercised. And exercising is actually buying the shares or selling the shares at the strike price. And that you can, if you hold it, you can do that whenever you want. But again, typically, if you're holding an option and it's in the money and you're worried that maybe the price will go back down again, so you want to exercise it right now, well, there's still time value in there. And so if you exercise the option, the only money you're getting out of it is the intrinsic value, the discount that you're getting. But if you sell the option instead of exercising it, you get the value of the intrinsic value as well as the time value that remains. So again, exercising the option is very rare because it usually makes sense to sell it instead, or because you can't afford to exercise it anyway because it would cost you enough money to buy 100 shares. All right, let's talk about margin trading. Margin trading is borrowing money from your brokerage with your brokerage held assets as collateral. So if you had $100,000, like maybe if you participate in the Investopedia game and you give the game that gives you $100,000, for example, and you spent $90,000 of it buying stock or mutual funds or whatever, you've got $10,000 in cash left. What's your buying power? How much more can you buy? $10,000. because that's how much cash you've got left. And in the end, you could have $100,000 worth of assets. But if you do margin trading and you spent $90,000 on assets, you've got $10,000 of cash left, you still have $100,000 in buying power. Because now to do this, you have to open up a margin trading account that typically includes contracts and things. But basically, the brokerage will lend you the money on the basis that, well, if you don't pay back, we can just seize control of the assets that you're buying or that you've already purchased. So as long as your portfolio, whether it's cash or investments, is worth $100,000, then your margin trading account's buying power is $100,000. So this is a real moneymaker idea where, I mean, you could compound it, right? I mean, if you say, okay, well, I've spent $100,000 to get $100,000 value of portfolio, and then I'm going to take another $100,000 on my margin account and buy more assets. Well, now your assets are worth $200,000. So do you think you could borrow more money? Right? Like you could, as your assets grow, and since you own more, if they're growing, then you're making even more money return on your investment than you could have. I mean, if the market was going up 12%, but you've basically doubled what you can buy because you're on margin trading, then now you're making 24% on your own money. Now, it is a loan, so a couple of important things apply. The brokerage will charge you interest on the loan. So that comes out of the returns that you're getting. Also, the brokerage can call the loan at any time. So, for example, if they say, okay, well, your portfolio value is $100,000, so yes, your margin account buying power is $100,000, and I go and spend all of that money, so now my portfolio is supposedly worth $200,000, but then the market hits a downturn and it falls 30%. Now my portfolio isn't worth what it was, and the person lending me the money is feeling like, ooh, I don't know that I'm going to get all my money back, so they can force me to sell enough of my portfolio to get out of debt or to at least make them feel more comfortable. And I might have to, I mean, being forced to sell your portfolio when it's a market downturn, that's a really sucky time to sell your portfolio. You usually want to sell when it's high after you bought it low. So if it was my own money and it was a market downturn, I wouldn't sell. In fact, I might try to buy more because everything's on a discount. What would you do at a grocery store when prices fall 20%? We call that a sale, and we go and buy more stuff. In the stock market, when it falls 20%, like, oh my gosh, and some people might say, we gotta sell. No. This is when you buy. You sell when it recovers, okay? So basically, margin trading is another one of those high risk things. Now you can increase your returns by borrowing money and spending it, but it's, it could turn out to rake you across the coals. So it's definitely not a beginner thing. And I personally don't think I would ever get into it. There's another kind of loan, which is short selling. Short selling is when you sell something you don't own, and then you buy it later. What you sell, so let's say I'm going to short sell Microsoft. So if Microsoft is trading at $284, and I sell it, I'm going to get $284. Then I have to buy the share sometime later. I'm hoping that the price goes down. If Microsoft falls to $274, then I made $10. If Microsoft goes up and I have to pay more for it, then I've lost money. So short selling reverses the incentive or what I would predict that would lead me to that. If I thought Microsoft was going to go up, I would buy Microsoft. If I thought Microsoft was going to go down, I would sell Microsoft before it went down and then buy it later. What you sell before you buy is a real share. Its buyer has a share legitimately and they're going to keep it. Where did that share come from? Because you didn't have it. The answer is the brokerage has a stash of shares of various stocks that they will use to loan you so that you can short sale. The brokerage can call the loan at any time. They charge you interest, again, because it's a loan. And if they feel like, the price is going up instead of down, you might not have the money to buy that share to pay us back because they want a share back because they lent you a share. So they might say, we're concerned about your ability to pay to buy that share back. You have to do it now. So even if the price goes up, you're like, oh boy, I don't want to buy now. I'm still hoping it's going to go down. The brokerage might just say, tough, you got to buy it now. In which case it locks in a loss for you. So short selling is another risky investment, but it's a way you can potentially make money when you think the market is going to go down. When you buy to close, meaning you buy a share to get out of debt to your brokerage, you make money if you buy the stock for less than you sold it, obviously. The loss risk is unbounded in short selling. It's about as, it's sort of like selling a call option in terms of the magnitude of the risk. Because you sold something and you have to buy it later at no matter what the price. At some point, at any time after you short sell, your brokerage can say, now, you have to do it. And so if the price went way, 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 way up, you have to buy it. And often you'll short sell more than one share. So it could be this multiplying effect. And so that could be dangerous. Again, brokerages probably won't let it get to millions of dollars that you lose because they're going to want to make sure that they get their money back. So they'll probably force you to. And in fact, this forcing, which is called a short squeeze, happened recently in the news with GameStop and Robinhood. You may have heard about it. GameStop stocks were crumbling. They've been falling for a long time. And there was a lot of short sellers. So a lot of people decided, I'm going to sell now and buy later because the price is going down and I'll make a profit as it goes down. So they're profiteering off of a company's decrease in value. That's just the market for you. But a lot of people on Robinhood, which is a brokerage that caters to people who consider themselves less market savvy, a lot of those customers of Robinhood decided, let's stick it to because all these Wall Street fat cats are making money off of GameStop's losses. Let's stick it to them. And what they did was, it was kind of this mob effect of, they started buying up GameStop stock. And remember, the price of a stock isn't how much it really ought to be worth. It's market sentiment. It's what people are willing to pay. And as more and more people at Robinhood started buying GameStop stock, it drove the price up artificially. Now, when you have a bunch of short sellers and the price is going up instead of down, the brokerages get nervous, as we talked about. And so the brokerages would then turn to the short sellers and say, you have to buy now. You don't get any more time. Well, that turned all the short sellers into buyers, which further drove the price up. And the more the price went up, the more short sellers were on the hook to buy now, and they couldn't wait for the price to fall again, which it inevitably probably would. But it became this cascading effect started by a few Robinhood people, or a bunch of Robinhood people, that drove the price up some, and then the short sellers collapsed and and what it basically did is it moved a bunch of money from the short sellers to all the Robinhood folks. If the Robinhood folks ended up selling at the higher price, then they made a lot of money, and the people who were short selling lost a lot of money. And it was a really, really big thing in the news. And that kind of demonstrates the risk to short selling in the market, because that sort of thing can happen. So that's it for today. We covered options, short selling, margin trading, and next week we're talking about cryptocurrency, which is probably going to be the last class in this particular series. So just to remind you, we have a playlist with all the past and future classes in this series. And if you can check out the playlist, or you can subscribe to the channel so that you'll be notified when future videos come out. When this series is over, we're probably going to create several short videos that give tips and tricks along the way. So if you hit the subscribe button and maybe the bell button, you'll definitely be notified of when those things come out. And please consider sharing this with your friends. Everybody can profit from learning how to invest their money wisely, as we've talked about in this class, and I hope you'll share this.